These past 2 weeks have seen some incredible moves on the stock market. I don't think any of us were expecting the steepest drop since 2020, and then a rebound that ranked in the top 10 one-day recoveries in all of stock market history that we have recorded. It can be a scary time for investors. It really can. But I do want to reassure you of something that I think a lot of people miss during these times. If you're invested properly from the beginning, even these wild market moves shouldn't really worry you. If they do worry you, it might be because you're just not allocated properly based on your goals, or you may just not fully understand the way that statistics play out in the stock market and benefit you over the course of your time horizon, assuming that you're invested appropriately. Investing really shouldn't be a scary thing. In fact, it's one of the most exciting things we can do so easily in the modern age. It's possibly the greatest wealth building tool invented in all of history, one which can lift all boats and improve standard of living across the whole world by sharing the wealth of economic growth. It's really exciting. Investing isn't gambling, but many people often treat it that way. They think of it that way even. They want to make a quick buck because they hear the stories about a stock or a currency or an option that just went crazy, multiplying its value in a very short period of time. Or they hear about a friend or a friend of a friend who's making money in up and down markets, quote unquote. Or they hear that they can double their money every year investing in, let's say, wine or real estate or angel investing. The list goes on and on. And yes, there are people out there who have captured some extraordinary returns, truly, truly high returns on their investments in a very short period of time. And there are people out there who have won the lottery. These things do happen, but the lottery winners don't typically attribute their win to skill, whereas investors almost always do. Here's the truth. If you can grasp this truth early on, you'll have no trouble achieving millionaire status. About 70% of your success is going to come from two very easily controllable factors. Asset allocation is first. This refers to how your portfolio is divided among stocks, bonds, alternatives, and cash. Digging a little bit deeper, this can also refer to the subcategories of those main categories, such as large cap stock versus mid or small cap stock, growth versus value stocks, domestic versus international stocks, developed nations versus emerging markets, various economic sectors, government bonds versus corporate bonds, commodities, real estate, currencies, futures, options, precious metals, etc. But to keep things simple, think broadly in terms of stocks, bonds, alternatives, and cash. Based on your individual situation, considering such things as income, expenses, assets, liquid assets, which means readily accessible, debt, goals, time horizon, personal feelings towards risk. One person's investment portfolio might look dramatically different from another's. There's not a one-size-fits-all investment portfolio, which is why investment advice can only be given on a one-to-one basis. The second factor is this: time in the market. Now, this refers to precisely the number of days that you spend invested in the market. Jumping out of the market can significantly hurt long-term investment returns, especially because most people like to do something proactive when markets turn choppy, precisely the time when markets can capture some of their best recovery days. Now, here's an interesting fact and kind of a scary fact. Missing just 10 of the best trading days over a 20-year period can cut an investor's total portfolio in half. And most of those best trading days tend to happen during times of high uncertainty, when markets are trying to reprice due to new information being presented. So, is investing difficult? It's simple in theory. It's not so easy in practice because we have to resist our own inclinations to act on greed or fear, whether due to a lack of confidence or overconfidence. Allocate properly from the beginning and trust the theory deeply enough to stay the course and let your portfolio do its thing, which includes downturns, and you can far surpass the average investor's returns over the long term. Consistency based on well-founded strategy is the key. There are many investment strategies that will work so long as you maintain consistency. Some will work better during certain market periods and not so well during others. It may be vice versa for another strategy. But similar to dieting or exercising, there are many ways that can be done. You just have to believe in it long enough to stay disciplined to the approach. Dalbar is a research company that focuses on investor behavior. They regularly publish their findings on how investor behavior consistently causes significant underperformance as compared to the broader stock market. So, for example, in one of their more recent releases, they showed that the average equity investor only captured an average of about 16.5% return in 2024. You know what the S&P 500 made? It was over 25%. That's giving up almost 9% of upside. Think about this. Let's take $100,000, for example, and invest it for 20 years. But let's assume we miss out on 9% upside in year one, like the average investor did in 2024. And then let's assume after that, the investor averages 9% returns for the remaining 19 years. The one who gave up the early upside, like investors in 2024, has about $599,200 by the end of 20 years. The one who captured the full market upside in year one ends the 20 years with about $642,810. That's the exact math there with that calculation. So with just that one mistake, the investor has paid for this mistake with about $43,000, which is 43% of his or her initial investment. Making mistakes like this become more and more expensive as one's net worth grows, and it becomes especially expensive if the same behavior causes continual underperformance over the years. So, studies show that this is the case. For example, Dalbar has previously shown, depending on the timeline that's studied, investors often underperform the broader market by about 2% because of their tendency to change strategies and try to limit risk. So they try to do too much. If we run this illustration again, let's assume the investor not only misses out on 9% of year one's returns, but he also misses out on 2% of every succeeding year's returns on average as well that follow that. If the behavior is not corrected, this is a very realistic likelihood. It's proven in studies that this happens. So in that case, the underperforming investor has actually missed out on over $200,000. $221,340. That's a total of 221% of the original investment. It's life-changing. Think about it. If they'd simply just purchased the SPY, which is the ETF that tracks the S&P 500, and left it completely alone for 20 years through bear markets and bull markets, the investor in this hypothetical scenario would have made $220,000 more than the one trying to manage and time the market. The investor did the simple thing and won big time. The investor that tried to complicate and control things that they couldn't really control, is the one who lost control and paid very dearly for it. If you come away with nothing more than the simple truth about the value of time in the market, then you will have radically changed the course of your potential future. Now, does that mean that we should never, ever try to limit risk during certain times in the market cycle? Well, the answer to this is a little bit nuanced. It depends largely on one's time horizon. So if you're a short-term investor, there are things you can do to reduce risk as an ongoing strategy, as well as a response to certain market indicators. And the risk of being wrong here is far less expensive than for the long-term investor. If you're a medium-term investor, you can do something similar, but perhaps without quite as much risk reduction, so that you can still try to capture significant upside. If you're a long-term investor, which typically means 10 plus years, you can use risk reduction techniques, but it can become a drag on the portfolio that costs long-term returns. Whether you use these risk reduction techniques or not largely depends on your personal desire to take on the risk of missing out on some upside in order to hedge some downside. You may make more than you would otherwise have, or you may make less. That's the risk that you take, because timing the market is not an exact science, and downside protection costs some upside potential. I keep a running analysis behind the scenes of market likelihood of entering into a bear market, which is an extended downturn that drops 20% or more from the recent high point. These tend to last 10 to 12 months on average before turning around, but they can even last a good deal longer in the midst of deep recessions. That's why these can be the most important to hedge if it can be done in time and while minimizing the risk of being blindsided by a shorter term pullback or market correction, both of which happen with far more frequency than a bear market. In any given year, the chances of a bear market happening usually ranges between 20 and 25%. This year, by my estimations, it's kind of hovering right around 50 to 60% chance. So it's a bit higher. It's a bit of a coin flip right now, really, which might be the reason for especially those short and midterm investors to take a less risky approach. But I do think that if the present US administration can succeed at what they're trying to do, this massive restructure, along with a balanced budget, the potentials of AI, and eventually the merging with quantum computing, could mean the start of a really excellent bull run in the markets. It has the potential to reestablish the US as the global leader for years and decades even to come. But success in this outcome is far from certain. We're presently in a situation where so much is changing so quickly that uncertainty could become even more uncertain in the days ahead. Things are just happening very, very quickly, and it's hard to predict what's the next surprise going to be. The rules of the game are changing, and so radically sometimes that it might cause businesses and consumers alike to slow their spending until the bout of change comes to an end, or at least a slowdown. The problem with this is that a slowdown in spending could induce a temporary recession. I don't know if that will happen, and I'm not even predicting that, but I'm saying it's a higher possibility right now than it appeared at the beginning of the year. I think the next 3 months are critical to whether or not this manifests itself or things turn around. So the most important thing for long-term investors right now is to capture all of the upside, and especially those best trading days that usually happen in the midst of uncertainty and big down days. And so staying invested, even if it means riding through a bear market, can still be the best strategy for capturing long-term returns. In my estimation right now, there is still some downside potential. I would say probably about 12 to 13%. If it went any more down than that, I would be surprised. But I do think there is still some room for markets to probably suffer a little bit more downside, at least in the next month, potentially, even extending into July and August if things continue with the same degree of uncertainty as they have over the last several weeks. But the upside, on the other hand, I think is very strong in terms of what its potential could be for the next 12 months. In my view, looking at 15 to even up to 30% upside 12 months from now, I think that's very reasonable. So odds are weighted, in my view, towards the upside. We might just have to suffer through a month or more of continued volatility while we wait this out. So for short and midterm investors, focusing on diversification and limiting risk through the use of bonds and the right alternatives like holding protective put options on the broader market can help reduce downside risk, even if it means reducing some part of upside potential. It helps guard against the potential of a bear market or the worst effects of one, if it actually takes place, which right now is, like I said, probably the flip of a coin. I keep you up to date with economic news and analysis, followed by financial strategies in the weekly newsletter, which you can receive in order to micro-learn your way to becoming one of the most well-informed investors in the room. I encourage you not only to subscribe to this channel for weekly content, but also to subscribe to the newsletter to get additional deep dives to help you navigate news and markets while gaining a stronger grasp on how all these things work together. So remember, broad asset allocation and time in the market. Beyond stock picking, sector picking, or market timing, these two simple things stand the greatest likelihood of dramatically improving your success as an investor over the years. So weight the odds in your favor and aim for above average returns by focusing on those two simple factors that are well within your control. Then regardless of what markets do in the weeks ahead, you will be well prepared for staying the course toward reaching your ultimate goals.